Much of the thinking behind serious wealth happens away from the public eye. Advisors Angle aims to unlock that thinking. Together with wealth architect Neil Brink, we aim to explore how sophisticated investors build, protect, and steward long-term capital.
The older RAs has been the life-wrapped RAs, where you paid exorbitant fees on it, and that's why they typically don't grow.
What has changed in the structuring of retirement annuities?
We don't sell life-wrapped RAs anymore.
Okay.
It's an open platform. There's no commission on it. It's only wealth management.
Okay. And what fundamental difference does that then put in place for, say, someone looking at an RA who's previously never had an RA? Why would I then want to lean into an RA?
Because of the tax benefits it gives you.
We did see that. We did see the most recent announcement at the budget speech this year was the contributions towards retirement annuities. The first 350,000 used to be exempt. Now it's the first 430,000 that's contributed into all the 430,000 capped per annum contributions. That's the maximum exemption.
Of course.
Is that the most I can get out of it?
Definitely not.
But the law says that.
Yes. So the law states 27.5% of your gross income capped at 430,000 rand.
So if my 27.5% of income is more than the 430, I only get up to 430,000.
Yes, but now that has been construed into something like, I am only allowed to contribute 430,000. That's not what the law says.
That's a very clear distinction. That's a very different distinction. What I'm allowed to contribute versus my taxable exemption that's afforded to me.
Very important distinction.
Okay. How does that then affect
so you get a taxable deduction
per annum?
Section 11F, right? Per annum, up to 430,000.
What happens beyond that?
Nobody said you're capped there.
What happens beyond that?
Every rand you put in more than 430,000 becomes what we call a disallowed contribution.
Okay.
Dealt with under Section 10C. A disallowed contribution goes and sits on your IT34 and it heaps up over time for you to use upon retirement.
How?
So at retirement, you essentially have two options. Option number one would be to draw from your RA all of the money that you've over contributed. So you get your 550,000 rand tax-free plus everything that you've disallowed contributed to it. You can get tax-free from it as a lump sum. That's option A.
The disallowed contributions are tax exempt.
Yes.
In their entirety.
In their entirety.
Why?
And remember, from now until then, let's assume a 10-year contribution period, right? For the 10 years that you've over-contributed, the money inside of the RA grows tax-free. And the money in the RA is exempt outside your estate.
Okay.
Now, just back to your question, why is SARS being so nice to me to give me that over-contribution tax-free? It's been taxed already. Remember, if you over-contribute to an RA, the only exemption you got was 430. The rest of it was taxed at your normal pay-as-you-earn scale.
After the pay-as-you-earn scale and after the tax bracket you fall into, what you choose to do with that money afterwards is at your discretion. And if you choose to then over-contribute to an RA, you've already been taxed. Okay.
There we go. So you've already been taxed, so you're getting your own after-tax money tax-free.
Okay.
But the benefit of over-contributing is essentially stands on two legs. It's the tax-free growth over time inside of the RA, and then, of course, secondly, protected outside of your estate.
Let's expand on that. I know we've got a separate conversation around estates and estate planning. Let's expand on why this sits outside of your estate.
Of course. So a retirement annuity regulated by the Pension Funds Act, pensionable money is protected outside of your estate. For the very simple reason, I don't want to get too deep into the law, but for the very simple reason is you don't own it. As soon as you contribute to a retirement annuity or a pensionable fund, it is under the ownership of the pension and not of your estate.
It's not in your personal name.
That's why you can add a beneficiary to it and it will be protected outside of your estate. What would have been your alternative? If you've simply contributed the 430, the rest of the money is taxed, it's in your bank account, you decide to not add it to your RA. You would have put it in a discretionary investment.
Hopefully.
To really simplify this, let's say you just slapped it into a money market into your bank.
Over the same 10-year cycle.
Over the same 10 years, you would have paid interest tax annually on the interest earned inside the bank.
And only received the 23,000 Rand interest exemption on that portion.
That's it.
Okay.
Secondly, should you, God forbid, die in this 10 years, that money market would befall your estate and attract 20% estate duties and attract your 3.99% executors fees.
This is where, again, structuring becomes so important.
Same money we're talking about.
Same money. I want to get a sense of this in the most practical sense, because for some individuals out there that watch the pod, they're in this scenario. You're in this tax bracket already. And unavoidably so, and you're wanting to maximize on the absolute benefit or minimize the taxable contributions that you then make. Can we break this down more practically?
Then it's probably time for a case study.
Love these. So what do we have, Nellis? I think for me, the case studies, the numbers really tickle my brain.
And it should give you something to relate to, right? Where we can practically use it. So, client is a public officer or a office bearer.
Okay.
So what that would practically mean is typically a director of a public listed company. Now, why is this relevant? That means this client has to receive a pay-as-you-earn salary with a pay slip paying normal pay-as-you-earn rates.
Okay.
There's no, because remember, it gets published in the company's financials.
Yes.
There's no way around this. He can't invoice the company for his services. He can't move money around. He can't receive his bonus somewhere else, or shouldn't be receiving it somewhere else. He needs to earn that straight salary, go straight through the pay scale, and then pay as you earn.
Okay.
Right. So typical solution for a client such as this would have been contribute. Remember, this has only been recently increased. It used to be 350K. Now, if we just go one step back to basic financial planning, you're supposed to save 15 to 20% of your income, regardless of law, legislation, taxes. That's just the way the math works out. You need to put away about 20% of what you earn over time to have enough when you stop earning to replace that earning.
Okay.
Simple math. But now, because of this common misconception that you are capped at 430, this client would have put away 430
every year.
The rest of the money would be taxed straight at 45%. That after-tax money, he would have then placed into a discretionary investment.
Okay.
Let's roll this forward for 10 years.
So every year receiving 8 million Rand per year with an end bonus of 20 million Rand after 10 years.
In year 10.
Okay.
Right. So this client would then, over this time, have earned 100 million Rand. Paid 45% tax on it. Because, I mean, you can agree with me, the 4.3 million in deductions on 100 million is negligible.
And the 4.3 million is, of course, the 430,000 over the 10 years, because that's all they would have been benefiting from. So
only thing you can benefit from.
Of the 100 million Rand over the 10-year period, the 4.3 is where we end. In terms of taxable benefits or tax break.
Absolutely.
Okay.
So the rest of the money after taxes would have been invested in a discretionary investment. At year 10, he would have then retired.
Okay.
And then he would have earned an income from two avenues. He would have had his living annuity. That's where we, of course, converted his retirement annuity to a living annuity. they would have drawn a monthly income from it.
So the 4.3 that would have
Yes.
been exempted, assuming that was the max contribution, would have then been where we draw the living annuity from.
4.3 would obviously be quite a bit higher because it's been growing over this 10 years. But the 4.3 plus growth over time would then be in his living annuity, and he'd start receiving a monthly income from it. But remember, because he's gotten the tax break, SARS is not that much your friend. They're not going to give you a second tax break. So the income you receive from your living annuity will be taxable.
Right. So that amount was not taxed whilst he was working.
So
Is now needs to be taxed.
So
Right.
you'll be paying monthly income tax on that to your normal pay-as-you-earn scale.
Okay.
The rest of the money would have been sitting and growing in a discretionary investment,
Hopefully.
where he would have paid interest taxes, dividend withholding taxes, capital gains taxes. God forbid this client dies. The discretionary investment would go into his estate,
Okay.
immediately triggering capital gain by selling the asset, befalling the estate, attracting 20%, assuming his estate's lower than 30 million.
Estate
knowing
duties.
This kind of client is probably more. And then, of course, the 3.99% executors fees.
Okay.
And the arduous process of going through the winding up of the estate, his wife or beneficiaries waiting for years on end for that estate to be wound up before they can get access of what little is left.
Okay. So
How do we
that's
fix
how it
this?
would typically be dealt with. Let's now go through a structured solution.
And this guy would be of the opinion that this is the only way because I am a public officer. There is no way to treat this differently.
And there's no way to treat the receival of the
No way
incomes
to treat that
differently, whether we're looking at the typical solution or the structured solution. It's about what you then do
afterwards.
Okay, let's get into that.
So the way I would have advised this client is to contribute annually. Remember, back to financial planning principles, he needs to invest much more than 430. Contribute annually 1.43 million to the RA.
1,430,000 Rand per annum into the RA.
Now, technically, you should even be contributing a little bit more. I've just done it this way to simplify the math a little bit. So 1.43 per annum to the RA. So forget about these red alarm bells that's going off and saying you're capped at 430. You're not.
So you're contributing, and the 1.43 million is still less than, or is still in line with the 27.5% allowable contributions by law.
Correct.
Okay.
Capped at 430. So what does that mean? He will get in Section 11F deduction, same as there, for the 430 portion thereof.
Okay.
But now what happens to the 1 million? The 1 million, or then cumulatively, it would have been 10 million over the 10 years, gets allocated to Section 10C, disallowed contribution.
Right. This is that disallowed contribution you said that sits on top of the existing RA and its own contributions. So now I'm contributing 1.43, of which every year 430,000 is exempt.
Yes.
And I receive a further exemption on the 1 million under a separate piece of tax legislation being Section 10C.
So that 1 million, important to understand, is not exempt from income tax.
Yes.
Exactly the same as the first solution. It's not
Okay.
exempt from income tax. It's a public office. He needs to pay it. But after the 1 million befalls the RA, that money will grow. Remember, now we're going to the rules of an RA or the Pension Fund Act. That money will grow tax-free. So in his discretionary investment, it attracts all of these taxes, interest, CGT, dividend withholding. None of that is payable inside of the RA.
Okay.
So the money will grow tax-free over time.
Again, not to say I'm limited in where the money is invested from a product set, but rather the structure under which it's
thereof.
invested. Okay.
Product said we can buy equities, we can buy bonds, we can buy cash. I'm going to make the assumption he did the same in the discretionary side.
Absolutely.
Right. So same investment, same growth, but this one's tax-free.
Okay.
That 10C disallowed contribution then heaps up on his IT34 annually. It'll grow 1 million, 2 million, 3 million.
Over the 10 years.
In year 10, he's achieved everything he's promised, right?
Earned his bonus.
Earned his bonus. Gets paid 20 million. Remember, public officer, that 20 million gets posted in the company financials. So it has to go through his pay scale. Pay as you earn, he nets 12.
After the 45% deduction, 20 million rand as a bonus would inherently put you in the 45% tax bracket anyway.
Yes. Then he would have added the 12, option A, to his discretionary. Option B, we add the 12 in year 10 to his RA.
So in year 10, instead of contributing 1.43 million as I have for the previous 9 years, I'm now contributing 13.43 million.
You got that right, folks. It's a 13.43 million rand contribution to an RA in a single year. All of that money then goes against his IT34 disallowed contribution.
Okay.
Why would we bother?
Why is this important? Absolutely.
There's two elements to this. From year 1 to year 10, we get tax-free growth on the money, which you don't need to be a mathematician to understand that that's going to be a better place to be than he would have been in the discretionary investment.
Which again, we can assume you're still investing in the same underlying assets from a growth perspective.
Yes, exactly the
But
same.
under
Same
one
underlying,
scenario, taxable, under another, non-taxable.
Should, to the second point, in this 10-year run-up, he pass away, money is protected outside of the estate.
Exempt from estate duties.
Exempt from estate duties, it would be inheritable by his beneficiaries directly.
As is.
Whereas the discretionary investment would have landed inside of his estate.
Okay.
But now we get to the grand solution. At end of this contract, the client retires. We take that RA and we go and buy a living annuity with it. If you buy a living annuity and this client has then at that stage got a, what would that amount to? A 22 million rand disallowed contribution pool. Now, how did I get to the 22? It's the 12 he added at the end plus the 1 he added every year.
Yes.
22 million rand disallowed contribution pool on his ITA 34. That would mean that he can then deduct money monthly from his living annuity tax-free.
So
no
draw
income
down.
tax payable until the 22 million is spent. So that should take, well, depends on how expensive his lifestyle is, but that should take this guy well beyond the next 25 years.
And then at that point, after that, the remaining, which would have been the 4.3 million contributions under the typical example, that is then taxable in line with taxable income. However, effectively, you've been able to defer 22 million rands
Worth of
taxes and earnings that you can now draw on because you were previously taxed on them already, and they're exempt from the estate.
And in no scenario here, exactly that point, in no scenario here, you'll pay tax on growth. In no scenario here, you will pay tax in the estate.
Am I limited to how I draw down on those over contributions?
Living annuity, different set of rules. So 2.5% to 17.5% per annum allowable draw. But from proper financial planning, we don't think you should spend more than 4.5% to 5% of capital in any single year. So that allowance of 2.5% to 17.5% is so broad. If you draw 5 and something percent from it, it should be more than enough to cover your income for the next 3 decades.
And all we did here was over-contribute to an RA within allowable limits, allowable in the sense of legislation,
Yes.
and defer what it is that we're going to be taxed on and grow on to the end of the cycle and just structure it differently. That's all we did.
No magic here. We use the legislation that was given to us. Just use it. You tick all of the boxes by being a public officer. So everything above the line, taxed, clean transfer to an RA, fees and performance exactly the same as it would have been there. But because we optimize tax, we make a massive difference in this client's life from a planning perspective.
Well, I can think of 22 million reasons why this client would want this option. It's remarkable. That's absolutely remarkable. All we've done is adjust how we view the same existing legislation, and we've dispelled a myth, and we've saved a client a ton of money.
Just by thinking about it, starting with the plan and not the bricks.
Niels, this deals with the myth or truth that RA contributions are capped at the annual exemption that is offered.
It's only your allowance that's capped. There's no cap on an RA. You can put as much money as you want in there. The only cap is your Section 11F tax deductible. And we have simply over years been conditioned, but that is 350 or now 430. It's capped at that. I shouldn't put 1 cent more than that in there. You can contribute as much as you want. Look at this guy slapping 12 million in there in 1 year. That is possible. You simply use the legislation. Turn the page, read on the second page. That's where they deal with Section 10C, right? It's not only limited to 11A. An RA is one of the best, most underutilized products out there. Make sure you understand it. Make sure it's properly invested. And it can give you a tool to increase your savings by 27.5%.